Alrighty, so let's get started here. We are talking about the build to rent strategy. As previously mentioned, we're not talking about big builder stuff. We're not talking about huge apartment complexes. While that would be great at some point for me to do that, I really just want to give you guys kind of the overview of how this works. And you can apply it to duplexes. You can apply it to 10 units if you want. When you start getting bigger, then there's some more kind of red tape and hoops to jump through. But anyway, so we'll get started here. Alrighty. So really quickly about me, for those that don't know, my name is Jennifer Beatles. I'm also the founder of Agents Invest. Agents Invest is a network of investment savvy real estate agents. I got really frustrated a couple years ago when I wanted to invest out of the area and found that there was no place to find really good agents. You kind of just had to go find them yourself. So I created a network of really awesome agents and share those with our clients. Yeah, with Agents Invest. So I've been building and investing since 2007. We kind of actually sold off some of our portfolio last year. We're down to 20 units right now, and then I also have done some passive investing in apartments. I have just one right now, 192 units in San Antonio. And then, my current focus really is continuing building here in the Western Washington area, and then focusing on out-of-state apartments, larger apartment complexes. So that is about me. So just really quick, what we're going to cover. So I'm very systematic in my thought process. So I like to cover the why, the what, the where, and the how. So we're going to talk about the benefits and challenges of building new. We're going to talk about how to find, analyze, finance, and estimate costs, because that's a big thing, especially here in Western Washington. And then we're going to talk about who you need to hire. Building is not, well, really anything with real estate, you can't really do by yourself or just with one person. There's a lot of different people involved. And when you get into building, there's even more people involved. So definitely going to cover that all for you guys. And then I'm going to talk a little bit about where to build. That's a common question that I get anytime I'm talking about building. So I'll just give you guys some feedback on what I've seen there. Alrighty, so how I got started. So this is a photo of me. This is 2008. This is actually 10 years ago. Believe it or not, I was 22 years old, and they actually let me in an excavator, which is interesting. But basically, kind of how I got started here. So in 2007, I had purchased my first house, and I just went all in on real estate. I quit what I was doing, quit college, and decided that I wanted to go work for a local building and development company. And I got hired on as an admin, but I never really did admin stuff. I did a lot of project management, hiring of contractors, the bidding, the billing, pretty much anything and everything. Just a lot of just seeing these projects through. But one thing that was really interesting about this company that I worked for is they had a build to rent strategy, but for investors. So in addition to the owners building and selling spec houses, they actually built duplexes for other investors and then for the owners. So in this photo, actually I'll show you the next one. That's me. I am tearing down a single family house in order to make way for a new Rambler duplex. And I really now love heavy equipment. I even married a heavy equipment operator. So I guess it was my destiny. But anyway, so I worked pretty much for them from 2007 to December 31st of 2009, which is also my very last day of ever working for anyone else. And when I quit working for them, I really wanted to focus on building new construction houses because I saw a huge opportunity. The opportunity really was there was a lot of subcontractors looking for work. There was a lot of land available. Properties were really cheap. A lot of people were focused on flipping houses, but no one was really building houses. So, my initial focus back then was, was purchasing projects. This project actually, so there was 4 of these. They were duplexes, which we ended up condoing them and selling off individually, which I'll kind of talk to you guys a little bit about more. But basically the builder had started these. There was foundations in the ground, and then the bank canceled his loan. So basically he did the foundations, of course had the permits and everything. And then the bank said, okay, no more. And then, by the way, we're calling the note. So I went in, negotiated a short sale, and we acquired the land, and then we were able to finish it off and make a really great profit, actually. Then we moved on to higher end homes. So the top one there, that was a view house in Everett off of Dover Street. And then the other one down there was in Arlington, some acreage property. But basically, yeah, the higher end homes also, went really, really well. As you can tell, well, the photos are a little different, but I basically used the same colors on everything and just kind of systematically put these things together. But basically, I kind of learned that while the profits in the building, and selling were great, I wasn't creating any passive income streams. And I learned that passive income is so much better. And then there's also a lot less taxes than a big chunk of active income. So that's really kind of how I started getting focused on the build to rent. So specifically on build to rent, I just want to cover the benefits here. So first things first, it's very similar to a BRRRR. For those that don't know, BRRRR stands for buy, renovate, rent, and refinance. And a lot of times you're buying really ugly, terrible properties that need big renovations. And then, you're getting tenants in there at a higher, rent than what previous tenants were because the condition is improved. And then on the refinance, the value of the property has gone up so much because you've, done all this work and gotten good tenants in there, and now they're paying more. So the whole thing with a BRRRR is that you buy, a property that's underperforming or undervalued, fix it up, stick tenants in there, refinance it, get back any of your initial investment, and then you continue on with that property, and then you recycle whatever, capital you would put into it into the next one. So same thing here. That's really the name of the game. Is, you want to build these things, refinance, get all of your initial capital back, and then be left with a brand new building that cash flows really well, that now, you have all this equity. So when I put in there equity 25% plus, right, that's the maximum LTV on these is 75%. So you're always going to have at least 25% equity in these when you're done. So they're super easy to rent. When I was working for the new construction company, I also did tenant placement for them. And anytime you have a brand new building, it's kind of like, there's a certain person that wants to buy a brand new car just because they know that, there shouldn't be many issues, you get a warranty, things like that. Tenants feel the same about new construction. No one's lived in it. There's not going to be any funky smells, and you can get a premium for that. The other thing that, is great about build to rent is that you can build whatever does not exist or has a high demand. So, right now I'm building a 4-bedroom Rambler duplex. That is very, very rare. That is very hard to find. There's some specific reasons for why I'm doing that, and I'll talk about that in a little bit. But basically, when you're building new, you can decide, hey, okay, what's not out there and what has a high demand, and I'm just going to go build that. The obvious thing also is that there's reduced maintenance and repair costs. I mean, something that's brand new, you're not going to have a ton of maintenance and repairs unless you just got tenants in there that are just beating the thing up. And then of course you get warranties, right? You get warranties, manufacturer's warranties, you got sub warranties, things like that. So that's just fantastic. And then it's a really easy condo conversion at the exit. So I had mentioned, actually, let me go back to these ones. So these were duplexes that we condoed and sold them individually. The condo process is actually really simple and super easy. Yes, you do have to set up an HOA in order to sell to an end user that can get conventional FHA or VA financing. But it's really super easy to do. And actually, I have a whole condo slide, so I'll leave that there. But it's an easy condo conversion if you're deciding to exit it with an individual unit as opposed to a duplex or whatever you're building, fourplex. So this is just an example of some numbers on the project that I'm working on right now. So I'll be all in on a duplex, so 2 units. 4 bedrooms each side, $390,000. That includes, my land. That includes everything. I have an appraisal for $650,000, which means, and that's the construction appraisal, right? So it actually may end up being, if things continue like they are, it actually may end up being more than that, which means that I can have a maximum new loan amount of $487,500. Now, when I say new loan amount, a construction loan is only good for 1 year. So you do have to refinance that at the end of the year, or at the end of basically when you get certificate of occupancy. And unless you're doing like WaFd does have a product that is an all-in-one. I don't like their prepayment penalty, so I don't use them for that. But there are some options that exist for that. We can cover that when I go into loans. So in this example, I can pay myself completely back for anything that I have into this deal. And then I can also pay myself an extra $97,500. And then these units will cash flow, or both units, I should say, $11.52 per month. And that's, including about 10% in expenses. And that's a little bit low because for one, it's brand new construction. And then for two, I'm actually building this for supported living. So that those guys I've built in tenants. The second that we have certificate of occupancy, these guys are going to start paying $2,400 a month per side, which is just phenomenal. They pay all the utilities, they pay everything. I can have a 0% vacancy rate, things like that. So my ROI on this is infinite, right? I mean, I have no capital into the deal. If anything, I can decide to pay myself an extra $97,500 and then still have a cash flowing property. Alternatively, I have another option, which is probably the option we're going to do, but I can just refinance what we have into it. Now, I say the new loan amount just for easy factors of $390. I'm going to have some refinance costs in there, which I could either pay out of pocket or roll into the loan. But I don't want to confuse anyone by having different numbers there. So in this option, I'd still have the cash flow. So the cash flow would be higher, $1,706 per month. And then I'd have $260,000 of equity in the property. And again, I have, none of my own capital into the deal when I do this refinance. So again, my ROI is infinite. I guess the other option too, I could condo and sell. There's a huge opportunity, if people are wanting to do basically build to sell. I think that is just awesome to do it on a multi-unit basis and condo these. So for example, I comp these out at $415,000 per unit as condos, which means that would have a total sale price of $830,000, in which case I could make a gross profit. This is again before factoring in commissions and excise and title and escrow, but of $440,000, which is pretty incredible. Now, the reason why I bring up all these three different things to you guys is because I want to get you thinking about the different opportunities. Well, for one, the benefits, the different opportunities, and then also whenever you're doing a strategy like this, you want to have more than one winning strategy. A lot of times I see people going in where they can only win in one way if that one, option goes well. And as we all know, things don't always go well, right? So, if for some reason, I wouldn't go into this only wanting to sell these, right? I wouldn't go into this only, planning on getting all that cash out because maybe values will change, right? So I think that's something, to really consider as you're doing these is everything looks really good on pro forma, but then real life kicks in and sometimes things happen that we don't plan for. So I like to run my numbers a lot of different ways to kind of look at best case scenario, worst case scenario, other options if for some reason, I needed to sell these or whatever. This is just kind of how my thought process works with these kind of deals. So I'm going to look at, so 390 included acquisition, the demo of existing. So there was no demo. This one, I should say, this is kind of a unicorn deal, but they exist. I bought this property on the MLS last year, right? So not 5 years ago or 8 years ago or whatever. And it was a single family house and on 2 lots. And you guys, I see this all the time. Agents don't know what they're listing. They don't realize, what they have. And so I bought this house on 2 lots, did a boundary line adjustment, flipped the house next door, and essentially was left over with a basis of about $20 to $25,000 on this lot. So yeah, it is abnormally low for my all-in price, because I got the lot so cheap. So definitely, but it's out there. Like I said, definitely, these things exist every day. And this is in Everett. So to give you guys some context of location about this example that I'm giving. So great question, and moving on. Okay. So now that we've covered all of the benefits, I want to be really, really clear about the challenges of building. So first things first, everything can and will go wrong. So I've been red tagged, I don't know how many times, more than I can count. On one occasion, a homeless person started a fire in one of my buildings, decided he wanted to move in for the night and got cold and started a fire. And that was an interesting process to deal with. On my current project, my framer walked out for 3 weeks, finally got him back today, which is great. And prior to that, the foundation guys had messed up, and I had to have them jackhammer out some slabs. That was interesting. Prior to that, I've had paint selections go wrong. I've had, windows get missed where they should have been installed, which would, have more lighting in that room. Things like that. Neighbors complain, and especially when we were doing a lot of the view houses. Anytime you're taking away someone's view, they're not usually happy about that. So everything can and will go wrong, and that's just something that you kind of have to live with. The other thing is there's a moving target with these. You will never have 100% certainty that you can do what you're wanting to do with land until you get a building permit issued. A lot of times, you can talk to someone at the city or at the county, and they'll tell you can do something, and, you look up in the code and it all looks like you can do it. And until you get that building permit, things can change. I had actually in this project, we were initially going to be building 4 units because we were zoned for that, and had gotten all the way down to the end. And really, we were like 2 feet short of the 10th parking spot that we needed in order to get the 4 units. And so we had to scrap all of that. We had actually spent about 9 months pursuing a land use action to do these 2 separate duplexes, because I didn't want to do fire sprinklers and have a commercial product building a 4-plex. So I just thought, hey, I'll have 10-foot separation between 2 duplexes. I'll still get my 4 units. But I'll be able to kind of scoot in and not have to do some of the stuff that's related to commercial. And at the end of the day, it just didn't work out. So fortunately, I had run my numbers and had done such a good job on the land acquisition that it worked just fine as a duplex. But yeah, I should have been, it would have been an even better deal had I been able to get 4 units, but it didn't work out that way. The other thing is it does tie up capital for a while. So I know in a lot of this, I've been saying, oh, you're not going to have any money into this deal, infinite ROI. But the thing is, you do have to tie up some capital in, acquiring the land, in getting, all of the surveying done, the engineering done, the plans done, pretty much paying for everything up until building permit. I know some banks might have some options. We'll cover that on the financing side, where, they'll do lot loans and things like that, but you're still going to have a good amount of capital up front to do all these things and get it to the point where the bank loan, will go through, will fund it. And then you'll get reimbursed for a lot of that stuff. But, in some cases you can have, the capital tied up for a year or longer. And then at which point you'll get it all back. But again, it ties it up for a while. The other thing is it can be stressful. So if you're a person that just gets really stressed about anything that I've just mentioned on this slide, then maybe building isn't for you. There's nothing that says that you have to do every strategy that's available. But keep in mind, there's a reason why, builders exist, because there's a lot of money to be made. There's a lot of profit in these. But there's definitely a lot of, things to go through in order to get that, right? The risk reward correlation is definitely here and definitely on the building side. Another thing to point out, other challenges, you can receive misinformation from the listing agent and or the seller. So I've had, them say that they've got, permits for things and, things that were kind of approved through the county that have been expired. And then, that they said were ready to go or could be used and ended up being expired. I've also had a lot of people just think that they have utilities on the property and they're just not. I had a situation where, it was actually another one in Everett, and I was under contract. I think we were going to be able to put about 12 units on that one. And the agent had said, oh yeah, of course it's connected to sewer, no problem. And so when I went to verify the size of the sewer stub, the sewer district informed me that they actually do not have a sewer connection there. It ended up being, there's a manhole close by, but it was going to be, like I think it was like $150,000 or so, in order to make that connection, in order to open cut the road, shut part of the road down and everything. And so I just had to walk. I mean, that was something that, was kind of frustrating because I had had a lot of time into it, but, those things come up. And then another thing is, sometimes planners are not interpreting code the same. So the building code for every municipality is kind of like the rules of the game. I like to get really familiar with those before I, really talk to them, so that if they try to get me to install sidewalks or, do bike lanes or things like that, I want to know, I want to see that in the code. I don't want them to just be giving their personal opinion, because a lot of times that can happen. I had another one where we were working on, it was actually going to be 4 duplexes in Lake Stevens, and everything was good. I brought my site plan in, and we were actually within a couple weeks of closing. To talk to the planners multiple times, things like that. And then all of a sudden at the last second, they said, oh, actually we need a cul-de-sac for 2 of the duplexes, which was just crazy, and it wouldn't fit. And, the thing was that they were not interpreting the code, but I couldn't get to the point where they could confirm or deny that the cul-de-sac was required. So again, had to walk away from that one because it just didn't make sense. So bottom line here, guys, you must verify everything. If someone tells you, yes, the utilities are on the property, get specific details on which utility, and is it stubbed to the property or is it in the front of the property? Because that's a very different thing. So definitely have to verify everything, and verify it from the actual district, not just, again, what a person says. So, well, now let's talk about how. So I'm going to cover what's included in feasibility studies, and then I'm going to talk a little bit about what to build. Again, that's a common question of like, okay, now you have this land that's zoned, multifamily or whatever, but what do you build? So we'll cover that. And then I'm going to touch on the financing, and then how to determine costs, which is also kind of another fun one. Okay, feasibility studies. So here's where it can start to get a little crazy. So literally I just have a checklist, and I have questions that I know that I need to get answered. So first things first is, where are the utilities? So big thing is there a sewer stub? It's very common for people to say sewer available, but that means a lot of different things to a lot of different people. So I'm specifically wanting to know if there's a sewer stub. A sewer stub means that, the sewer district owns the main, right? And then there's a section of right-of-way. And oftentimes, or I shouldn't say often, but the best scenario is when you have a stub to the front of the property, going through the right-of-way to the front of the property. Now there's different levels of stubs though. Sometimes there's a 4-inch stub, and sometimes there's a 6-inch stub. Oftentimes a 4-inch stub can support 2 units or 1 duplex. A 6-inch stub can oftentimes support 4 units or 2 duplexes, or sometimes, or a 4-plex. anything that is typically anything that is above 4 units, you're going to have to enter into what's called a developer extension agreement and do an 8-inch stub. That's kind of when you're getting into bigger stuff, but that can get pretty expensive. So let's say you find out that there is a sewer stub, and you find out that it's a 4-inch stub, and you're wanting to build a fourplex, then you're likely going to have to go back to the main and do a 6-inch stub. So again, be prepared for that. You can get bids and everything for that, but that's a common thing that the sides of the stub, people don't look into. Next is water available? So it can be kind of like sewer, right? Hit or miss. A lot of times it seems to be a little less expensive to get water to a property than sewer, but that's a question that you're going to need to figure out. The other thing is, as I'm mentioning all of this, you're going to need to figure out who owns the sewer and who owns the water. I had a situation actually in Bothell. I don't know, Cody, if I saw you on the line there, but I was helping Cody with the deal, and I had called City of Bothell and North Shore, and both of them claimed that the other one had the sewer. And finally, I went back to both of them and I said, okay, guys, you both said that either, the other one had this. What's the deal? And literally it took someone going out to actually go to the site to realize, oh yeah, that is ours. So, oh, hey, Cody. So anyways, it can be hit or miss. You've got to figure that out of like, okay, whose sewer is here? It's very uncommon that you'll have like different, if there's sewer in the street, it's owned by, one company. It's not like you have multiple choices here. You really get like whoever's, nearest by. I had another situation where an agent said, oh yeah, sewer's in the front of the property. And I had saved that detail because this agent seemed very competent. He had already been through 2 buyers, and this was Alderwood Sewer District. And I had left that call for last on my feasibility checklist. And so anyways, called the utility company. They informed me that the sewer is actually not in front, it's on the side, and that they did want the sewer to be completely brought down through the right-of-way in order for future property owners to connect to, because this was a corner lot and there was no sewer in front. And so the cost for that would have been well over $100,000. And that's, again, something that even though the sewer was on the side, so I guess technically it could have been the front if you would consider the side street the front, but they wanted it to be completely brought down. And that's, if you guys didn't already know, that's how these municipalities get sidewalks. That's how they get sewer extensions, is by developers. And so a lot of times the developers have to bring, especially on these corner lots, the sewer main all the way down for future people to connect to. So a lot of times, even when I'm looking at really raw land, there's a whole strategy that could be, waiting until developers come in to develop the surrounding areas and then bring the sewer closer to, your property and then connect. So anyways, that's just another thing on sewer. Is gas available? So gas is not necessarily as important. I mean, obviously you can use electric power, but it's always great if gas is close by, because then, tenants like it better, and things like that. But that's something you got to figure out. And a lot of times that's a PSE or a Cascade Natural Gas. And you have to fill out a form in order for them to let you know if it's available or not. Are frontage improvements required? So usually anything that is triplex or above is always going to have frontage improvements. Frontage improvements are curb, gutter, sidewalk. Sometimes they want bike lanes. Sometimes they want trees planted and things like that. So you're going to need to figure out what the requirements are for that. I'm a Snohomish County gal. I pretty much stay in Snohomish County or Skagit County. There's a loophole, or kind of a loophole, I guess, but duplexes are considered residential for Snohomish County, so frontage improvements are not required. So it's great. So the next thing is soils analysis. So that's where you're going to figure out what you can do for your drainage plan, and then also how deep your foundation is going to be. If you dig down and you're not, and the excavator is not getting to bearing soil, then you're likely going to have to excavate all that out and bring better dirt in. So again, it's going to get super, or I shouldn't say super expensive, but more expensive in having to do that. And then are there wetlands? That's again another challenge. A lot of times, you're looking at maps online. You are walking the property, trying to figure out, if it's wet or not. Almost anything that you're going to be walking in the wintertime is going to be wet, so it's a little bit hard to determine. And a lot of times you just get a wetland person out there to figure it out. Permit fees. So for permits, you're also going to have what's called mitigation fees, or what they call impact fees. And what those are is basically when you're adding new units or new developments, you are impacting the roads, the schools, the parks, things like that. So you have to pay a per unit fee depending on where you're building for that. So be prepared for that. Utility connect fees is also another one. Those can get pretty pricey. On this duplex that I'm building, it's actually $16,000 per unit for the privilege of connecting to their sewer line and their water line. So that is what it is. You don't have a choice. And then as far as these feasibility studies go, they typically take between 10 to 30 days, and that's usually what is asked for in any kind of purchase and sale agreement. 30 days is obviously better. A lot of times, especially in this environment, sellers don't want to grant that. But 10 days is usually more than enough to get everything done if you have your checklist and you know what you're doing. So bottom line, the value of the land is based on the above. So I had kind of given you guys some examples of deals that I walked from, and honestly, I walked from them, as you guys heard, is mostly for utilities. Because there's, could be tens of thousands or hundreds of thousands of dollars to get, utilities there. So that makes the land values be considerably lower when you have to do all these improvements in order to just get to the point where you can build. So that's something that, that really, of course, on all of those, I went back and tried to negotiate with the sellers and said, look, it's going to cost me $100,000 to get the sewer here. But that's a big bite to take off for a seller of, reducing their price $100,000. So sometimes it works out, sometimes it doesn't. So really quickly, again, on utilities, sewer and capacity fees have multiple fees: capacity fees, which is the connection fees, meter, inspection, and permit fees. And then you've also got to pay a contractor to get it to the property or get it connected. Sometimes gas can be free if you have enough appliances. So if you do call the gas company, they're going to ask you, okay, well, what are you connecting to gas? What's going to be gas? Do you have hot water heaters? Do you have a gas dryer? Are you using gas for the range, the stove, things like that? And if you have enough, then a lot of times they'll just bring it to the property for free or at a very, very reduced cost in exchange for that. So power, I haven't really talked about power, but power can be several thousands or tens of thousands, depending on the size of the current transformer and if it needs to go underground. So I had another situation where the power was overhead across the street. And of course, PUD wanted it to be bored under the road. And a new PED said, I think it was going to be about $30,000. And that was for 12 units. Just getting the power over there. So FYI on that. I see some comments coming in, so I'm going to really quickly pause. All right, is there an average amount that the studies all cost? Gosh, it's a really good question, and it really depends on the property, but let me go back to this. There's no fee to call around and get utility, figuring that out. Soils analysis, to get an infiltration report, you're probably going to spend about $2,000. For a wetland report, depending on what you're doing, if you just need to get a letter that there's no wetlands, that could be $250 to $500. If you have to do a full wetland study on like acreage, that could be thousands. So I hope that helps. It could be a couple $100. It could be a couple thousand. If you're paying for a survey, that could be, again, a couple $1,000 to a lot if you have a big property that you're doing. But a lot of times, if you work with the same survey company, they could probably come out and, survey for maybe $2,000 to $4,000. So some great questions on that. And then capacity charges can be passed off to buyers if your strategy is to build to sell. Correct. Yeah. Yep. Yep. You just have to put that kind of in the disclosure and everything. And then there's also, if you get into a developer extension agreement, and you're extending the sewer main, then you can be credited back when other people connect. So there's some different things you can do there. Okay. So I think we've covered utility fees here. So now I want to show you guys, oops, I don't know why it's going back and forth. Okay, so what to look for in the land. So first things first, you want to look at the power lines and see which side of the street they're on. So if they're on the opposite side of the street as the property that you're looking at, you're going to have to get that over the street. If there's already a pole set, you're probably better off, but that's something you want to look at. The nearest sewer manhole, that's pretty important. I think we've all seen a manhole right in the middle of the street. I think it says sewer on it. And so that's a sewer manhole. If it's in front or really close to the property, that's a good sign. That's a really good thing. Doesn't necessarily mean that there's a stub, but it means that there's sewer really close by. A gas valve in the street, those little kind of almost paved around. They're like maybe a quarter the size of a sewer manhole. If you see those are good. Water meters close by. Again, if you're kind of peeking around in the neighbor's yard and you see water meters, that is good. Slopes or elevation changes, again, as you're walking property and you notice some slopes or elevation changes, that's just, again, something you want to note. And then that you have enough width to fit the proposed buildings. I'm seeing a lot of land or lots for sale right now, and the width is like 40 feet wide. And they're narrow and they're long, or they're deep, and that's really hard to get multiple units on. The land might be big, right? It might be a half acre. But in something like that, you're not going to have enough room to put a building there and then get a driveway to get to back units or turn units and things like that. It just gets to be really difficult. Actually, I'll just show you guys really quick. So here's an example. This is the 2 lots that I bought. So if we are looking at, Google Earth here, as you can see, you can do this with any property. I see that the power is on my side. So again, that's great. My, fees to connect is a lot lower. I see that no one has frontage improvements here. And then, look at this. This is a lovely manhole that is kind of hard to see, but this is literally right in front. So as you guys are looking at properties, get really used to looking for the power poles, get used to looking for these manholes. As you guys can see, they're actually really hard to see anyways, but there are no little gas, I don't know if they're called gas valves, but I'm calling it a gas valve, the little gas thing in the street. And it actually turns out that there is no gas in the street. And I am a very long way away from where gas is, so definitely not paying to get that brought down. So this is just, again, an example of what you guys should be looking for in that. And then actually, if you go out even a little bit further, this is a kind of a loophole zone. You see a lot of, these are like, condo things here. This is a little condo project here. So this is a high density zoning in Everett where you've got a lot of still bigger lots on single family houses, but it's a high density zoning. So you can go in and, pick some of these off and just, like this one, actually, that looks really good. So if you're targeting, like if you're doing any direct mail or anything and you're wanting to do this building stuff, looking in some of these areas, going over, let me pull up just like the zoning map really quick. Again, this is Snohomish County. It totally works for King too, or wherever you guys are at. But you can literally kind of zoom in and look at different zonings and things like that, and set up searches based on zoning maps. You can set up searches based on the higher density zoning, and then you can search for, property size, bigger or larger, things like that. You have to really get in order to see the what the zoning is and things like that. So this is LDMR, right? So this is all low density multi-residential. So you can pretty much put almost anything in here. I shouldn't say anything, but yeah, so this is all LDMR, R7200. Okay, so getting back to this. All right. Okay, so what to build is the next question. So first things first, I like to work backwards and say, what does the zoning allow? So in my case, the MR zoning allows for 1 unit per 2,000 square feet. And I had like a 8,200 square foot lot, right? So that means 4 units. But then you need to look at the lot coverage, any height restrictions, parking requirements, and setbacks. And then also keep in mind anything that is 3 units and above for the municipalities side is going to be considered commercial, which means you're going to have to do fire sprinklers, which means you're going to have to do frontage improvements, and you're probably going to need a larger sewer stub in order to support that. So really quick, going back here, pretty much every municipality has their code published online. I always look first for the bulk matrix. So in this case, it gives you the different zones. It gives you the minimum lot area, right? So it says, okay, you need to have 7,200 square foot on a lot, different things like that, 8,400, 9,600, and then it has a minimum lot width. And then most importantly, or I shouldn't say most importantly, but you want to know what your setbacks are. So right here it says side and rear lot adjacent to. So in this case, I was MR and less than 20 feet high because I'm a rambler. So I get to use a 5-foot setback from the side and the rear lot lines. And if I was 20 to 30 feet tall, I'd have to apply a 10-foot setback. So FYI on that, definitely want to look at that when you're kind of going through some of these properties. So this is the bulk matrix. Pretty much any municipality is going to have these kind of things published along with parking and everything like that. Okay, so let's now talk about how you get financing. So local banks seem to have the best option for construction financing. So terms vary. Most want 25% of the overall project budget of your own money into the deal. That usually means you're paying cash for the land, and then they will finance you the rest for the building. So rates are anywhere from like 1 to 2 points plus prime. So prime is actually kind of high right now, or higher than it's been. I have a rate of prime plus 1. And so that's I think it was like 4.75 when I got it or whatever. So it's now, I think my rate is like 5.75. And then these construction loans are good for 1 year. And in order to apply, you need to submit a budget and plans. So they actually need your building plans because they're going to order an appraisal. And they're going to appraise it based on your building plans and your spec list. And then they will give you the funds upon building permit issuance. So you pretty much have to get it to the point where you have a building permit, show them that you've paid and picked up the building permit, and then they will issue you your loan. Really quick, I want to show you guys what an example of a spec list looks like. And if anyone needs this, I'm happy to share. It's not really that great. I mean, it just kind of covers everything. And but a bank is going to need this. You're going to need to tell them what you're using. If there's going to be masonry, if there's going to be bathrooms, this kind of stuff, HVAC, what all that. And actually, this is important because you want to give this to whoever is going to be building this thing too. So FYI, that's what a spec list looks like. Alrighty. Okay, let me get back here. Sorry, just getting back and forth. Okay. Now we're going to talk about how to determine costs. So there's really 2 different categories of costs. We have soft costs, which are not directly related to the building itself. An example of that would be the building plans, paying for the engineering and the surveying, permitting, course of construction insurance, loan fees, interest rates, things like that. And then soft costs are typically paid back to the developer or investor or owner, whatever you want to call it, upon loan issuance. So in my case, I just had those all included in the budget. Now, I had paid for them months ago, but when the construction loan funded, when I showed them my permits, I was reimbursed for everything that I had paid up to that point. And then how to determine costs. So hard costs. So hard costs are your actual physical construction of the building. So that would be like, your site work, the building structure itself, the lumber package, trusses, windows, garage door, anything to do with the building. And then, things like landscaping. So I don't like to give rules of thumb because it can vary so much, but I know that this is something I get asked all the time is what are the hard costs. So hard costs, or I should say, price per foot to build. So that's anywhere from $80 to $300 a foot. $300 a foot is going to be a really high end or a pretty high end something in Seattle or Eastside. $80 a foot is, going to be something that you can do in like, a market like Spokane, maybe even Mount Vernon, things like that where it's a lower cost area. And the biggest difference is labor. The materials costs don't change all that much, but the labor costs vary greatly. So that's definitely something to keep in mind. Question. Do they lump sum the loan or have construction draw inspections required and piece out the payments? Yep. So there's draws. Let me see where that one is. Okay, maybe I don't have a one for that. Yeah, so everything is based on a draw, and you have to line item your entire budget. Now, some of the downsides to that is if you say under budgeted on a line item, then you only get it. Let's say you put $10,000 in for the trusses, and the trusses ended up costing $12,000. You only get paid back for the loan on that portion, the construction loan, $10,000. If you have another instance where, let's say, you put in $15,000 for electrical, but the electrical actually only cost $10,000, you don't get to get the extra $5,000. So it's based on the invoice that you paid, but either the full budget amount or the full invoice amount. So a lot of times too, they have to come out and do inspections, and sometimes they charge for the inspections in order to give you the draw. I have actually been lucky because I've been working at the bank forever, and I sent them some photos and they gave me a draw kind of in the beginning without charging me for doing that inspection. So good question. Okay, so let's talk about who you need to hire. So this is kind of the short list really of, who you need to get this done. One is a land agent or someone to find a land for you, or if you own your own land, great. But someone's going to need to find the land. So that could either be you or someone else. I've actually been training and kind of coaching some agents here locally on how to find land for investors. So if you guys need some recommendations, definitely shoot me an email and I can make some recommendations for you, for agents who actually know what they're doing related to land and can kind of help you guys out. The other thing is you're going to need someone to build it, whether you want to be the builder or whether you want to hire a builder. And then again, someone's going to need to play the project manager role. That was always my role in my building. So I was project manager / land agent / permitting and everything. And then I hired a builder to basically build me whatever I wanted. But someone still needs to manage the builder. So either you hire a project manager type person or you fill the project manager role and you give the direction to the builder and answer questions and things like that as things come up. A land consultant is someone who, again, if you're working with an agent that maybe can't do all the feasibility or anything like that, the land consultant can do the feasibility study for you. Sometimes that can actually be a firm. So it could be like Western Engineers. They're a survey engineering company that also offers kind of consulting packages for feasibility. So that's, another role there. A permit tech. So someone to do the building permit side for you and do the submittals, do all the coordinating with the county. Civil engineer. That's someone that's going to do the drainage plan, the front end improvements and things like that. An architect or a drafter. An architect, you don't have to have a structural engineer to do the plans. They just have the stamp to do both. Or you can hire a drafter and then have the plans engineered by a structural engineer. That was actually always the way I did it. I could get plans kicked out for like $500 from a drafter. And then I had him send it over to the structural engineer, and then, $1,500 or so to have it done. So $2,000, and you had a whole plan done up, versus an architect who could be $4,000, $6,000, $10,000, $15,000. So I was always, kind of looking to go a more economical route, I guess you could say. And then you're going to need someone that can do the construction loan or just pay cash. But most people, I would say, get a construction loan and then someone to refinance it. So obviously, you'd want to make sure that you can do the refinance at the end before you get started in all of this. Because on the construction side, they're not as picky. Like I literally, have to fill out one financial statement and a tax return to get a construction loan. On a refinance, as you guys, I'm sure, know, it's a lot more than that. It's pay stubs, bank statements, letters of explanation for everything for jobs you had 10 years ago, all that kind of fun stuff. So it's a lot more challenging on that side. So going into more detail on that, I want to specifically talk about what to look for in a builder. My assumption is that most of you guys, if you do, take on this strategy, that you're going to want to hire a builder. So a lot of times the options include either a flat fee management plus costs. So meaning you pay a builder a flat fee for his management of the project, and then you reimburse him or pay for all of the related subcontractor costs. Another option would be an all-inclusive builder. That's just a builder that says, hey, $400,000 and I will build you this, duplex. That's another option. Another option I've seen is a percentage of cost as opposed to a flat fee plus costs. So in my opinion, I love the flat fee management plus costs. I would also a lot of times give bonuses if it came in under budget. So I'd give a couple $1,000s in bonus if it, came X percentage under budget or X amount under budget. I don't particularly like the all-inclusive builder price. I mean, the good thing is, I guess you know exactly what the costs are going to be. The downside is, they're probably having quite a bit of markup and you're probably overpaying, when you could, have some cost savings. Same with percentage of cost. I think that there's no incentive for the builder to save you any money if they are billing on a percentage of your costs, right? So I have always done flat fee management plus costs. And then I've also, found my own ways to kind of save money on, if there's an appliance sale or, things like that. Sometimes I've kind of gotten involved in some of the items that could have a huge savings and just pick those out myself. So again, that's taking much more of an active side on some of these things. But again, I mean, that could be several thousands of dollars. Other questions that you want to ask is, do they offer permit services? So like, can they do permitting in-house? And is there a dedicated project manager? So do they have a project manager that you can be working with, that can kind of save you time? And in that case, you might not need to hire a project manager. But these are some questions you want to ask. If they don't offer, so like my guy, he did not have a project manager. That was my job. And he did not have permit services. I mean, he, really just built for me, and had of course, all the licensing and everything to do that, and systems and processes, but he could not do the permitting. So, I had to kind of outsource that. Alrighty. So where to build? Captain Obvious here, where it makes the most sense. So, for some people, I know a lot of people who love to build in Seattle and have done very, very, very well building in Seattle. For me, I like to get in and get out of projects very quickly. And when I say get out of, I mean, get my money back, refinance, get my tenants in there, and then move on to the next one. In Seattle, it can take a lot longer, and the costs are so much higher. The sub cost, the labor cost, everything is so much higher. But again, I know a lot of people that have had a lot of success in Seattle. In another area like Spokane, like I had mentioned, we're doing that investment trip in October, but Spokane has super cheap land, quick permits. The costs to build start around $80 a foot. We actually have a builder over there. the agent that I work with, is building 6 duplexes himself. I think the builder is charging $20,000 a duplex for his fee, and he's paying about $80 a foot on the hard cost to get this thing done. My personal favorite is Everett, just because it's quick, cheap, it's a growing area. In some cases, it's too far north for the Seattle and the East Side builders. So there's like a few small builders that are kind of competition, but yeah, Everett I think is just a great place to build. It's just the fees are pretty low. It's quick, it's easy, of course, depending on what you're building. But that's personally my favorite. So I don't know if you guys have any other. Arlington is also fantastic. Marysville not so good, but Arlington is really great. I don't like Lake Stevens. I think their planning department is very anti-developer. So that is that's not my cup of tea. How about shoreline area? As for cost compared to Seattle or South Snohomish? That's a good question. I think that you'd probably do better in shoreline. I'm trying to think if I've ever had a project in the city of Shoreline. And I don't know that I've had, Kenmore and Bothell, Mount Lake Terrace, just a lot of different cities, but I don't know that I've had any experience in Shoreline. I don't know that I have much to give on that. But I would assume that being, outside of Seattle, the costs are probably going to be a little bit better. But I don't know what their mitigation fees are. I don't know what their, sewer connect fees are or anything like that. So I'm not sure. But I think as far as getting high rents, I think that'd be great. Okay, I hear shoreline permitting can be a pain. Okay, well, we might have our answer there. So, okay. If you guys have any questions, again, let me know. But I just kind of want to put this all together for you guys and then literally answer any questions that you guys have. I'm an open book, so anything that you guys have, let me know. So kind of putting this all together, guys. So I like projects where you can get in and get out quickly. So typically, I am not doing big land development type stuff where it's going to take you 2 to 4 years to get a building permit. I'm not saying that I wouldn't do something like that. I would just want to get the land for very, very cheap in order to put the time and effort into something like that. As you guys can see, I can kind of quickly, do a duplex and be, pretty quick in and out of that. So I would personally rather just do a bunch of 2 to 4 units, get easy, get in, get out, move on to the next one. I also, and this is really hard to do right now, but I want land to be 25% or less of the after completion value. So of course, if you have a property that, if you're building something and you think the after completion value is going to be $1 million and you don't want to pay any more than $250, and then you've also still got to factor in all the costs that you've got to get it to that point. So really it should be $250 with all of the kind of getting it ready. Yeah, Bubba's saying 30% max. Yeah. And I don't even like 30, but you're right. I mean, in order to kind of get a deal, that's sometimes where we're at. I obviously want to be all in. So all of my expenses at 75% or less of the after completion value. So again, if you have something that would be worth $1 million, you don't, want to be more than $750,000 if you want to get all your capital back. And then to point out, you could have something, and this comes up a lot on the BRRRR strategy too, is you could have, the 75% LTV, get all your money back, but if it doesn't cash flow at the end of the day, then I don't think it's worth it, to be honest. At something like that, you'd probably just want to flip. I know some people that are totally fine with that maybe, they cash flow $100 a month on something, but they felt good about doing the BRRRR where they don't have any money into it. And there's certainly something to be said about that. But for me and my strategy, I want cash flow as much as I can get out of every single property. I want at least $500 a unit, plus that equity. Again, it's a little challenging to do. But if you guys are looking and you're, out there evaluating land, it's definitely, out there. You just got to find it, got to kind of put these deals together. So anyways, whatever your cash flow criteria is, don't leave that out of your analysis, part of everything. I always do my, my budget, what I think it's going to be worth, my LTV calculation. And then I always include a cash flow calculation, because if I'm pulling all that money out, and again, I'm not cash flowing, then I don't know that that's a deal that I'd do. And there's been a couple of those deals that I've just passed on, that I probably could have been, all in or less at 75%, and it just didn't cash flow. Any questions, you guys? One thing I didn't cover is course of construction insurance. That's a special insurance policy that you need to get, that will protect you from, I had mentioned that homeless person started a fire in one of my units. The course of construction paid for that. So the good news is it didn't completely torch the entire building, or burn the entire building down. I didn't have too much fire damage, but but the course of construction, saved me on that. And then of course, when everything is done, you just put a permanent policy on that. But the banks are going to require that course of construction insurance as well. Any other questions? No questions? Did I answer all the questions? Did I give too much information all at once? Okay. What is your average return on investment? That's a really good one. So, well, in building, it's infinite, right? So there is no return on investment because I don't have an investment in it, and it's just cash flowing like crazy. But my average return on investment, just factoring in like for, let's just say, all of my regular rentals, is probably close to 20 to 25%. And that's not factoring in, equity or appreciation, principal pay down, or anything like that. And there's a couple of reasons for that, though. For one, we do a lot of work in-house. And then for two, half of our rentals are supported living. So we have 0 turnover costs, 0 utility costs, 0 vacancy rate. Those tenants stay for, 10, 15 years. They put another tenant in if someone leaves or passes away or something like that. So our costs are extremely low, for the majority of our portfolio, because we have those guys in there, and it's just easy. It's super, super easy. And then I do all of our own property management. I probably spend maybe the equivalent of 2 hours, maybe a month, and that's mostly on like bookkeeping type stuff, with our portfolio. And then, we maybe get one call every 40 days or so for like ticky-tacky stuff. Sometimes it's like a GFI. They don't know how to reset the GFI and have to walk them through it. But yeah, so I would say that's our average return on investment. If I factored it in if I added in equity and appreciation and all that, I would definitely say that we're recouping everything within a year, on that end, just because we're renovating these and, doing things like that. So really good question. All right. Okay. Ooh, that's a good one. I know you're not. So Sean, love this question. I know you're not done yet, but what would you do differently if you could go back in time? So, well, there's a couple things. One is all the houses that I built, and I say the last couple of years, it feels like 2010 was like a couple of years ago, but it wasn't. I would have rented those out as opposed to selling those. It was a short-term decision, which looked really good on paper to make a lot of money selling these houses. But had I put tenants in there, refinanced them, and kept them, then it would have been an even better deal. So I really wish that I would have kept some of those. I think I'm learning I learned from that how to think long-term as opposed to short-term. And I also, I'm really into delayed gratification now, right? So if I'd way rather get a couple $100 a month times 20, for the rest of my life, rather than $100,000 in a couple months that happens one time that I have to pay a lot of taxes on. So that's a really good question. I think that the only thing I would do different is probably do more deals, and then also do more, put renters in these deals that I was building, and just keep them. So that's a really good question. And now I have to catch up. Okay, is $2,500 per side on your duplex rent is upper end, or is that what they average for now in Everett? Yeah, so keep in mind this is a 4-bedroom each side duplex. So I'm actually getting $2,400 a month, or $4,800 total for the duplex. That's probably a little bit on the high side. The only reason I can get that is, well, for one, it's new construction, and for two, it's supported living. So I would say fair market rent is probably closer to 22, 23. Although it might have gone up a little bit, but yeah, it's a little bit higher. The other thing too that I didn't bring up is we actually paid extra to get the extra water and sewer meter. And it was something, we kind of looked at and we said, gosh, we could save, I think it was like $10,000 if we put everything on one meter, and then just have the tenants pay it because it's supported living anyways, and they're going to pay it. But in this case, we thought with the end in mind and said, hey, let's just pay the extra money. And if we ever condo this thing, we've already done the water sewer. And so that's super easy. So yeah, that's what we ended up doing on there. Do you do the property management yourself, or do you have employees? I do not have employees doing the property management. Like I said, literally it takes maybe 2 hours a month, and we get a call maybe every 40 days, 45 days or so. Super, super easy. But I'm pretty strict on my screening process, not so much on credit and things like that. But, I just don't want kind of complainer type tenants. So yeah, we rent to people that don't complain. Buy and hold, baby. Yep, Bubba. I love it. Have you done any projects out of state? If so, where? That's a really good question, Perry. I am dying to do an out of state construction project. I don't have any in the works yet. My guys in Oklahoma City, literally the other day, they were telling me about this opportunity area by the state capitol where a builder can purchase a 7,500 square foot lot for $1,500. The kicker is, though, you can't keep it as a rental. You have to resell it. And those in that area, they're selling for probably about $190,000, but you're getting the lot for $1,500, and they're not having any mitigation fees or anything like that because the city is really smart and they want builders to build more. They want more housing, things like that. So that's something I'm currently looking into. And then I'm currently looking in Spokane. Spokane's super easy for us. It's not, it's a 4-hour drive. And then I've got some great connections there, and they have a lot of land, and that city is growing. The rent per percentage change in Spokane over the last year was like 9%. In Seattle, it was like 1%. So literally Spokane is completely outpacing Seattle right now as far as the increase in rental rates. But the prices haven't, they're still relatively low. I mean, we had a client buy a fourplex there for $220 last month, duplexes for $135. I mean, there's some great deals there, but yeah, have not done any out of state construction yet. Working on it. Let's see. Do you only get 2 hours a month of work because most of your properties are so new? That's a great question. And no, actually, a lot of I think our oldest property is built in 1950. So we've got some 50s products, we've got some 70s, some 80s. But really, the 2 hours a month is, again, because our tenants just stay. We do really good renovations. Our properties are definitely not like high-end, A-class properties. We usually buy the C-type properties and just fix them up really nice. I also love the 2 to 4 units. So the majority of our portfolio is 2 to 4 units. And the tenants just stay a really long time. The other kind of interesting thing is everything we own is single story. And this duplex that we're building is single story. The reason why that is because, for one, it works for elderly or people with disabilities or things like that. And then it works for people with young kids. So I think that some of the reason why we have very low turnover is for that reason, because it's hard to find single story. So that could be it, but definitely not all new. What kind of specialized improvements did you do for the supported living? Literally nothing. Nothing. I mean, we did 4 bedrooms as opposed to 3. Because that's the maximum they can have, and they pay rent per room. So of course I squeezed in 4 bedrooms it's like 1,365 square feet, which is kind of small. But that was literally to the foot of how much we could build. But nothing else. No. The only other thing is we didn't do tub shower combos. We did stand-up showers, and I think people are getting away from tub showers anyway. It seems like showers, stand-up showers are the way to go. So that's the only really change we did. But other than that, just totally, we didn't do ADA, anything like that. Okay, and then let's see what else. What do you think of Everett 5 years from now, factoring Painfield with direct flights to tech hubs in California? Yeah, I think it's going to be great. We own another rental property really close to Painfield. I don't know if it's going to be good or bad, but we might convert that into an Airbnb later, because it'd be super close, to the airport there. So that's something that's an option. But I love Everett. There's definitely, the city has some challenges like any city. But I think that it has everything to be a great city. It's got the employment. It's going to have the airport. You've got the waterfront there. So yeah, I definitely see a lot of growth in Everett for sure. And that's why I love to build there too. All right. Any other questions, guys? Thank you so much for spending your evening with me. I know that, sometimes it's a lot to do these things in the evening, especially when it's nice out in the summer. But again, my goal is just to add value to you guys. I love this stuff. So I hope it was valuable. I hope I didn't just fire hose you with a ton of information, but I love it. I think that there's a lot of opportunity here, and I would love to see you guys take some of this opportunity to either, build to rent or even build to sell, and then eventually moving into the build to rent. But especially in the 2 to 4 unit space, guys, there's like no competition. So definitely would love to see you guys take advantage of this, and I'm here to help any way that I can. So let me know. All right, guys, thanks. Have a great night, and we'll talk soon.